Disclaimer.
It's January 14th, and the global financial system just hit the point of no return. While you were sleeping, silver officially crossed $90 on the screen, but try to buy a physical coin, and you'll see dealers asking for $110 plus. But that's not even the biggest story. UBS has just gone into a full-scale war with the Swiss government, rejecting a $24 billion emergency capital demand. This is the Basel IV nightmare coming to life. And at the same moment, BRICS is officially pulling the trigger on their gold-backed currency, the unit. The COMEX is facing a default because there is simply no metal left at these paper prices. Today, I'm showing you the leaked data. The mainstream media is too afraid to touch. If you have your wealth in the banking system, your time just ran out. Let's dive in. 7 days ago, something unprecedented happened in the silver market that connects directly to this crisis unfolding right now. On January 7th, the CME Group, the exchange that controls COMEX silver futures, made a move so aggressive that veteran traders could not remember anything like it outside of crisis moments. They hiked margin requirements on silver contracts by 47% overnight, forcing traders to suddenly come up with $32,500 per contract instead of the $22,000 they needed the day before. Think about that scenario for a moment. You go to bed with your trading account properly margined, wake up, and suddenly you need an extra $10,000 per contract, or you're getting liquidated before lunch. But here's where it gets interesting, and where our story really begins. Despite this massive margin hike designed to discourage physical delivery, 1,624 contracts demanded immediate physical delivery anyway. Not in March, not in May, the traditionally active delivery months when this kind of thing happens routinely. We're talking about January, a notoriously quiet month when sophisticated traders usually just roll their positions forward to avoid the hassle of taking actual metal. According to CME data, this backward rolling pattern, where traders actively seek delivery in off months, signals something the exchange does not want you to notice. Physical panic. Let me put this in perspective with a scenario that hits closer to home. Imagine you're planning a vacation to Europe and you go to exchange your dollars for euros. The currency exchange booth suddenly tells you that you need to put down 47% more collateral than yesterday to get the same amount of euros. And oh, by the way, there's now a 2-month waiting period for physical delivery. You'd immediately understand something was broken in the system. That's essentially what happened in the silver market on January 7th, except the implications reach far beyond vacation planning into the foundation of our monetary system. Now, pop quiz. What happened 37 days before this margin crisis that might explain why traders are willing to pay penalty rates for immediate physical silver? On December 8th, 2025, the BRICS nations, Brazil, Russia, India, China, and South Africa, along with their expanded membership, launched something called the unit. Not a press release, not a proposal, an actual functioning prototype of a gold-backed digital currency. According to the official BRICS announcement, they issued 100 units, with each unit backed by 1 gram of physical gold stored in distributed vaults across member nations. This isn't some far-off plan or theoretical framework. The infrastructure exists. The gold sits in vaults. The technology functions right now. Here's what should grab our attention about the unit's design. Every international transaction settled through the system bypasses dollar intermediation entirely. A Brazilian soybean exporter selling to China doesn't convert reais to dollars to yuan anymore. They settle in units, backed by actual gold, with both parties avoiding dollar exposure, SWIFT messaging fees, and U.S. banking sanctions risk. The World Gold Council reported in late December that BRICS nations now hold combined gold reserves exceeding 6,000 tons, giving them the physical backing to scale the system far beyond a 100-unit prototype. Fast forward to this morning, January 14th. Silver shattered $90 per ounce while you were probably checking your phone over coffee. But here's the detail that matters more than the headline price. The Shanghai Gold Exchange showed silver trading at a $10 premium over COMEX prices. $10. That's not a rounding error or a temporary arbitrage opportunity. That is a fundamental breakdown in the global pricing mechanism, where physical metal in Shanghai costs $10 more per ounce than paper contracts in New York, supposedly representing the same metal. Think about this scenario playing out in your investment portfolio right now. You own silver futures contracts on COMEX, feeling smart about your $90 paper gains. Meanwhile, someone in Shanghai holding physical silver can sell it for $100 per ounce in their local market. This premium gap represents the market screaming that paper and physical have divorced, and physical is moving to a new address without forwarding instructions. The registered inventory numbers tell an even darker story that connects directly to your purchasing power and retirement security. According to COMEX warehouse data, registered silver inventory, the metal actually available for delivery against futures contracts, has collapsed by 70% since 2020. We went from roughly 120 million ounces sitting in deliverable form down to about 36 million ounces today. Meanwhile, Open interest in silver futures has increased, meaning more paper claims are chasing fewer physical ounces. If you understand basic supply and demand, you already see where this ends. Let me paint you a picture of what's happening in the physical market right now. Indian silver refineries and jewelry manufacturers just declared $425 million in insolvencies over the past 2 weeks, according to the All India Gems and Jewelry Domestic Council. These aren't small operations going under because of poor management. These are established firms with decades of history getting crushed by margin calls they can't meet. When the CME hiked requirements 47%, these companies suddenly needed to post massive additional collateral on their hedging positions or face force liquidation. Many chose insolvency over liquidation, which tells you everything about their calculation of where physical prices are headed versus paper prices. The backward rolling pattern we're seeing reveals something crucial about market psychology shifting in real time. Sophisticated traders, the institutions with research teams and risk models, are now treating off-month delivery demands as strategic positioning rather than inefficient trading. They're essentially saying, we'll pay the penalty rates, we'll deal with the hassle of physical delivery, we'll absorb the storage costs, because we believe the paper market is going to fail to deliver at these prices. The CME's margin hike confirms they're worried about the same thing. Have you noticed how mainstream financial media isn't covering the story with the urgency it deserves? CNBC talks about silver as a commodity trade. Bloomberg mentions it in passing as industrial demand, but nobody's connecting the dots between COMEX delivery stress, BRICS gold-backed currency launch, and the systemic implications for dollar dominance. That silence isn't accidental, it's revealing. Here's the connection that changes everything about how you should view your savings, your investments, and your financial future. The unit backed by gold directly competes with the dollar backed by confidence in the Federal Reserve and the full faith and credit of the U.S. government. When that confidence wavers, say during a criminal investigation of the Fed chairman that just went public on January 12th, the appeal of gold-backed settlement increases exponentially. And when BRICS nations controlling 50% of global gold production offer a functioning alternative to dollar settlement, the physical metal backing that system becomes extraordinarily valuable. The Shanghai premium isn't just a number on a screen. It's the market discovering that physical silver in Asian hands trades at a different value than paper silver in Western exchanges. That $10 gap represents the early stages of a complete repricing of precious metals based on physical scarcity rather than paper manipulation. And if you're holding retirement accounts, home equity, or cash savings denominated in dollars, this repricing affects your wealth whether you own silver or not. What we're witnessing in real time is the infrastructure for a parallel financial system coming online while the old system shows stress fractures it can no longer hide. The margin hike, the delivery demands, the premium gaps, these aren't separate events. They're symptoms of the same underlying condition. The paper price mechanism is losing its ability to suppress physical scarcity, and the BRICS nations have launched an alternative that doesn't require dollar approval or Western bank intermediation. The question isn't whether this trend continues. The mathematics and the political will behind the unit guarantee continuation. The question is how fast it accelerates, and whether our existing financial institutions can adapt or will fight it until something breaks. Based on what happened on January 7th with those margin hikes, the exchanges are already in fight mode. Based on what's happening today with silver above $90 and Shanghai premiums at $10, the market is telling us the fight isn't going well for the paper system. Now let me show you the smoking gun that proves this is not speculation or conspiracy theory. It's documented fact sitting in official exchange data that anyone can verify. When those 1,624 January contracts demanded physical delivery, guess who stood on the other side of 99% of those transactions? JP Morgan. According to COMEX delivery reports, JP Morgan issued 8.1 million ounces of silver to satisfy January delivery demands, representing essentially the entire month's settlement activity. One bank, 99% of deliveries. In a month, that's supposed to be quiet. Think about what this concentration reveals about the actual structure of our silver market. You've been told that COMEX is a transparent, competitive exchange where multiple participants provide liquidity and price discovery happens through open market forces. But when delivery time arrives, when someone actually wants the metal instead of rolling their paper position forward, one institution controls the entire supply chain. That's not a market. That's a monopoly with a trading screen attached. Here's the scenario that should concern every American with a 401k or pension fund right now. JP Morgan isn't delivering this silver out of charitable commitment to market integrity. They're delivering because the alternative is exchange default and complete loss of credibility in the futures market. But their ability to keep delivering depends entirely on having metal in their vaults or being able to source it at prices close to the paper futures price. The $10 Shanghai premium tells you that second option is rapidly disappearing. The backwardation we are seeing in the silver market represents something that's not supposed to happen in well-functioning commodity markets. Backwardation means near-term futures contracts trade at higher prices than longer-dated contracts. Essentially, the market is paying a premium for immediate delivery versus delivery 6 months from now. In normal markets with adequate physical supply, the situation corrects itself quickly because suppliers rush to deliver into the premium, arbitraging away the difference. According to futures market data from the past 3 weeks, silver backwardation has persisted and widened, which means suppliers cannot or will not deliver at these prices. Let me connect this to your daily financial reality with a concrete example. Imagine you're a solar panel manufacturer in Arizona, and you need silver for your production process. You've historically bought futures contracts to lock in your silver costs months in advance, a standard business hedging strategy. But now the market is telling you that silver for delivery next week costs $92 per ounce, while silver for delivery in July costs $87. The normal supplier response would flood the market with near-term metal to capture that $5 premium. It's not happening. That tells you the physical market is far tighter than the paper price suggests. The Indian insolvency crisis I mentioned earlier provides the human cost of the system breaking down. $425 million in declared bankruptcies from firms that have operated successfully for decades, according to industry trade groups. These weren't speculative traders gambling on price moves. These were refiners and manufacturers using futures markets exactly as designed to hedge their business risk. When the CME hiked margins 47% overnight, these companies faced a brutal choice. Post massive additional collateral they didn't have liquid, or declare insolvency and shut down operations. Many chose insolvency, which should tell you everything about their assessment of whether they could survive in this new margin environment. Now let's talk about the elephant in the room that connects all these pieces: BRICS, gold accumulation, and production control. According to World Gold Council production data, China mined 380 tons of gold in 2025, while Russia produced 340 tons. Combined with the other BRICS nations and newly admitted members like UAE, Saudi Arabia, and Iran, the bloc now controls approximately 50% of global gold mine production. Not 50% of reserves, 50% of the actual annual production of new gold coming out of the ground. Have you noticed how rarely mainstream media mentions this concentration of gold production? They'll talk about OPEC controlling oil production. They'll discuss semiconductor supply chains. They'll analyze rare earth dependencies. But the fact that half the world is gold production now sits under control of nations actively building a dollar alternative barely gets coverage. That silence is strategic because acknowledging it forces uncomfortable questions about where our monetary system is headed. Here's where the mathematics get terrifying for dollar dominance. The BRICS nations have publicly stated their intention to increase gold production control to between 65 and 70% by year-end 2026. According to mining industry analysis, they're accomplishing this not just through domestic production, but through strategic investments in African and South American mining operations. When you control both the production and the reserves, BRICS combined official reserves exceed 6,000 tons. You control the physical backing for any gold-based monetary system you want to build. The unit prototype that launched on December 8th becomes far more significant when you understand this production control. Each unit backed by 1 gram of gold is not a theoretical claim on some vault somewhere. It's backed by gold produced and refined within BRICS control, stored in their own vault networks, immune to Western sanctions or asset freezes. Think about the security implication for a Chinese or Russian company choosing settlement systems. Do you trust your gold-backed unit stored in Shanghai and Moscow, or your dollar deposits in a New York bank that the US government can freeze with a phone call? Let me paint you a scenario playing out in corporate boardrooms across Asia right now. You're the CFO of a major electronics manufacturer in Vietnam. You import components from China and export finished goods to Europe. Historically, you settled everything in dollars through Western banks because that was the only option with adequate scale and liquidity. But on January 14th, you're watching silver hit $90 while your bank tells you UBS is fighting a $24 billion capital call from Swiss regulators. You're seeing the COMEX struggle to deliver physical metal. You're reading about JP Morgan controlling 99% of deliveries in supposedly competitive markets. And someone just offered you settlement in units backed by physical gold with faster clearing times and lower fees than SWIFT dollar transfers. What do you choose? The timing of Powell's criminal investigation announcement on January 12th couldn't be worse for dollar confidence. According to news reports, federal prosecutors are examining potential securities law violations and false statements related to the Federal Reserve's emergency lending programs. Whether the investigation has merit is not the point. The fact that it exists and went public creates a crisis of confidence in Fed independence at precisely the moment when safe haven demand for hard assets is spiking. Let me show you how this investigation timing connects to metal prices in ways that affect your wealth directly. When investors lose confidence in the Federal Reserve's independence from political pressure, they immediately question the value of dollar-denominated assets. That flight to safety traditionally flowed into U.S. Treasury bonds, but we're watching 10-year yields climb even as recession fears increase, a combination that shouldn't happen if Treasuries were still the undisputed safe haven. Instead, according to commodity trading data, institutional money is flooding into physical precious metals at a pace we haven't seen since the 2008 financial crisis. The correlation between Powell's investigation announcement and silver's breakout above $90 isn't coincidental. Major institutional players, pension funds, sovereign wealth funds, insurance companies, operate on quarterly rebalancing schedules with careful risk models. When the investigation went public on January 12th, risk committees across the financial world started emergency meetings to reassess dollar exposure. By January 14th, silver had crossed $90 with massive volume accompanying the move. This wasn't retail traders reacting to Twitter posts. This was institutional recognition that something fundamental has changed in the risk profile of dollar-based assets. Think about the compounding effect of these simultaneous crises hitting the financial system right now. The COMEX is bleeding registered inventory with demand accelerating. JP Morgan is delivering 99% of the metal while backwardation persists. Indian refineries are declaring insolvency from margin pressure. BRICS controls half of global gold production and just launched a functioning gold-backed alternative to dollars. The Fed chairman faces criminal investigation while safe haven flight accelerates. And UBS is telling Swiss regulators to kick rocks on a $24 billion capital demand, revealing that Basel IV capital requirements might trigger the next banking crisis. Here's what connects all these dots into one coherent story that changes everything about your financial planning. The paper-based monetary system built on confidence in central bank credibility is encountering physical reality in the form of scarce metal that can't be printed or margined into existence. The BRICS nations recognized this vulnerability and built an alternative system with physical backing. Western institutions are now choosing between admitting the paper system is broken or fighting to maintain the illusion until something defaults spectacularly. The Shanghai premium staying at $10 per ounce over COMEX prices for multiple consecutive trading days proves the physical market has already made its choice. According to exchange data, Shanghai Gold Exchange silver inventory is declining despite the premium, which means buyers are willing to pay $100 per ounce rather than trust COMEX paper at $90. That's not an arbitrage failure, that's a credibility failure. Physical buyers in Asia are telling you they don't believe COMEX can deliver metal at paper prices, so they're paying the premium for guaranteed physical settlement. What happens to your retirement account when this credibility gap widens further? Most Americans hold wealth in paper assets, stocks, bonds, mutual funds, ETFs. Even if you own a silver ETF thinking you have precious metals exposure, you're holding a claim on metal that may or may not exist in deliverable form. The prospectus for most silver ETFs includes language allowing cash settlement in extraordinary circumstances. Read that again. Your silver investment can be settled in cash if physical delivery becomes impractical. Meanwhile, someone holding physical silver in Shanghai just sold it for $100 per ounce, while your paper ETF is marked at $90. The proof is overwhelming, documented, and accelerating. This isn't coming. It's here. The only question remaining is how fast the repricing happens and whether you've positioned yourself for physical scarcity or paper promises. Now, let me show you the mathematics that make the next 90 days the most critical period in precious metals history since 1980. If backward rolling continues at the current pace we've documented, 3,000 plus contracts per month demanding physical delivery in non-active months, the COMEX faces a mathematical inevitability that no margin hike or exchange rule change can prevent. With registered inventory already down 70% since 2020 and delivery demands accelerating, the simple arithmetic tells you the exchange runs out of deliverable metal within 60 to 90 days at current demand rates. Think about what this timeline means for your investment decisions right now. You're reading this on January 14th. March is traditionally the next active delivery month for COMEX silver, just 45 days away. According to exchange delivery patterns, March typically sees 10 to 15,000 contracts stand for delivery in normal market conditions. But these aren't normal conditions. If we see even half the backward rolling intensity in March that we witnessed in January, the exchange will face delivery demands for 25 to 30 million ounces against registered inventory of 36 million ounces. That's not a squeeze. That's a wipeout. Here's the historical precedent that shows you exactly what happens when exchanges can't deliver physical commodities against paper contracts. In 1980, when the Hunt brothers drove silver delivery demands beyond available supply, COMEX changed the rules mid-game and moved to cash settlement on outstanding contracts. Silver was trading around $50 per ounce when the exchange intervention happened. Within weeks of that cash settlement announcement, silver spiked to its inflation-adjusted all-time high as the market recognized that paper price suppression had ended. Market historians document a 40% price explosion in the immediate aftermath of exchange delivery failures. Apply that 40% historical precedent to our current situation. Silver at $90 per ounce plus 40% takes you to $126. But that's actually conservative because the 1980 situation didn't include a functioning alternative monetary system backed by nations controlling half of global gold production. The BRICS unit adds a structural demand component that didn't exist in any previous precious metals squeeze. Let me walk you through the unit scaling mathematics that change everything about gold and silver demand over the next 12 months. According to the December 8th BRICS announcement, the prototype consists of 100 units, each backed by 1 gram of gold. That's essentially a proof of concept using 100 grams of gold. But the stated objective is full trade settlement across all BRICS nations within 18 months. We're talking about 10 nations with combined GDP exceeding $37 trillion, according to IMF economic data. Even if just 5% of international trade among these nations shifts to unit settlement in the first year, that's $1.85 trillion in transactions requiring gold backing. Here's where the calculation gets wild. If each unit requires 1 gram of gold backing and BRICS aims to maintain 40% gold backing as stated in their documentation, settling $1.85 trillion in annual trade requires approximately 2,000 tons of additional gold demand. That's roughly 65% of annual global mine production according to World Gold Council supply data. This is not gold for jewelry or industrial use. This is structural monetary demand that persists and grows as unit adoption increases. Think about what happens to gold prices when 2,000 tons of new annual demand hits a market where production is essentially fixed in the short term. Mining supply responds slowly to price signals because opening new mines takes 5 to 10 years. BRICS already controls 50% of current production and is targeting 70%, meaning the gold backing, the unit comes from supply they control. The rest of the world, Western nations, India outside BRICS, other Asian buyers, compete for the remaining 30 to 50% of production, while jewelry demand, industrial demand, and investment demand all continue. The World Gold Council's Q4 2025 demand report shows global gold demand already running at 4,800 tons annually before unit launch. Add 2,000 tons of structural BRICS monetary demand, and you're at 6,800 tons against annual production of approximately 3,600 tons. That deficit gets filled by either existing above-ground stocks flowing into BRICS vaults or prices rising enough to destroy demand elsewhere. Given that jewelry demand is relatively price inelastic and investment demand actually increases when monetary concerns rise, the price adjustment required to balance this equation is enormous. Conservative commodity analysts are now projecting gold at $2,500 per ounce by Q2 2026, based solely on BRICS demand and Fed credibility concerns. That's roughly a 15% increase from current levels around $2,170. But here's where silver becomes the story within the story. The historical gold-silver ratio, the number of silver ounces needed to buy 1 ounce of gold, has averaged around 55 to 1 over the past century. Right now, according to current market prices, that ratio sits at approximately 24 to 1 with gold at $2,170 and silver at $90. Let me show you why this ratio matters to your portfolio right now. If gold moves to $2,500 per ounce as BRICS demand projects, and the gold-silver ratio compresses to 22 to 1, which is historically tight but not unprecedented, silver trades at $113 per ounce. That's a 25% gain from current levels. But here's the kicker. Silver is a far smaller market than gold in dollar terms. According to precious metals market data, the entire above-ground investment silver supply is worth roughly $50 billion, while gold investment supply exceeds $11 trillion. Moving billions of dollars into silver for BRICS backing or safe haven demand causes explosive percentage moves that gold can't match. Now here's the scenario that keeps Western central bankers awake at night. March 2026 becomes the decision point where the COMEX either delivers physical silver against all standing contracts or admits they can't and moves to cash settlement. If they deliver, registered inventory drops to critically low levels that make April and May delivery months completely untenable. If they cash settle, the 40% historical price spike plays out while the Shanghai premium probably widens from $10 to $30 or $40 as Asian buyers completely abandon Western exchanges. But there's a third option that is actually more likely and more dangerous for your purchasing power. The Federal Reserve intervenes with emergency liquidity to support the futures market. Think about what that intervention looks like in practical terms. The Fed essentially prints dollars to buy silver at inflated prices, delivering metal to contract holders while debasing the currency in the process. This validates every argument BRICS has made about dollar instability and accelerates the flight to gold-backed alternatives. According to Fed balance sheet analysis, any intervention large enough to matter in the silver market requires hundreds of billions in new liquidity injection. Here's what this decision tree means for you personally. Path 1. COMEX defaults. Silver spikes. 40%. Paper contracts settle in cash, while physical metal trades at massive premiums in Asian markets. Path 2. COMEX somehow delivers metal through March, but registered inventory collapse makes future months impossible, leading to Path 1 delayed by 60 days. Path 3. Fed intervention provides liquidity, validates currency debasement thesis, drives institutional money into hard assets, and silver clears $100 on the way to $120 or higher as inflation expectations surge. All three paths lead to silver above $100 within 90 days. The mathematics, the inventory data, the BRICS demand structure, and the institutional flight to safety all point the same direction. The only variable is which catalyst triggers the final leg up and how quickly it happens. Let me bring this back to the UBS crisis that opened our conversation because it connects directly to the timeline we're discussing. When UBS rejected the Swiss government's $24 billion capital demand, they essentially told regulators that meeting Basel IV requirements under current market conditions would force a fire sale of assets at devastating losses. According to banking analysts, UBS holds approximately $90 billion in legacy Credit Suisse derivatives positions that are underwater in current market conditions. Forcing immediate capital raises means recognizing those losses publicly, which triggers the exact confidence crisis that Basel IV was supposedly designed to prevent. The Swiss situation is your early warning system for broader banking stress that accelerates precious metals demand. If UBS, one of Europe's largest and most systemically important banks, is fighting regulators over capital requirements, what does that tell you about the state of other major banks holding similar derivative books? According to Bank for International Settlements data, global banks hold over $600 trillion in notional derivatives exposure. Even a tiny percentage of that going bad creates capital requirements that make UBS's $24 billion demand look like a rounding error. Here's the calculation that should terrify anyone trusting the traditional banking system with their wealth. The Basel IV rules require banks to hold more capital against risky assets. Precious metals, derivatives, and commodity exposure fall into categories requiring higher capital charges. When silver volatility spiked from the $60 range to $90 in recent weeks, every bank with silver derivatives exposure saw their capital requirements increase substantially. If silver continues to 100, 110, 120 over the next 90 days, those capital requirements explode. Banks either post massive additional capital, or they close out positions by buying physical metal to settle contracts, which drives prices higher and makes the capital problem worse. This is the doom loop that ends in cash settlement, Fed intervention, or price explosion, your choice of catastrophes. And it is all playing out against the backdrop of BRICS launching a functioning alternative that does not require Western banks, COMEX exchanges, or dollar intermediation. The unit, backed by physical gold, becomes more attractive with every Western banking crisis, every exchange delivery problem, every Fed credibility concern. So, what do you do with this information? First, understand that the next 45 to 90 days represent the decision point for the entire precious metals market structure. March COMEX deliveries will tell you whether the exchange can handle physical demand at current prices. Second, recognize that your dollar-denominated wealth faces serious purchasing power risk whether you own silver or not. The Fed intervention scenario means inflation. The cash settlement scenario means confidence crisis, and both outcomes hurt cash savers. Third, consider that paper claims on silver through ETFs or futures carry settlement risk that physical holders do not face. The Shanghai premium at $10 over COMEX is not market inefficiency. It's the market telling you that physical in hand trades at a different value than paper promises. That premium probably widens to $20, $30, or $40 as the March delivery crunch approaches, and more buyers recognize the settlement risk in Western exchanges. We're watching the birth of a parallel financial system built on physical backing and controlled by nations holding the production and reserves to make it function. The old system built on paper promises and central bank credibility is encountering physical reality in the form of scarce metal that can't be printed into existence. Between now and March, you'll see which system the market chooses, based on the evidence we've reviewed: the delivery demands, the backward rolling, the Shanghai premiums, the BRICS production control, the inventory collapse. The market has already chosen. The price is just catching up to reality. The question isn't whether silver reaches $110. The mathematics make that virtually inevitable within the timeline we've discussed. The question is whether you've positioned for physical scarcity or paper promises, Whether you understand the risks in your current portfolio, and whether you're prepared for a monetary system transition that happens in months rather than years, the data is public, the timeline is clear, and the decision is yours.